You bought the breakout. The price wicked straight through your stop loss. Then, without hesitation, it reversed and ran exactly where you thought it was going, without you. Sound familiar? That's not bad luck. That's not a coincidence. That is inducement. And the market does it to retail traders every single session. Welcome to what I'd call the single most important concept separating consistently profitable traders from the 90% who blow up their accounts. Today, we're doing a full masterclass on inducement and liquidity traps, the hidden mechanics underneath every major market move. Stay until the end, because I'm going to show you how to flip this from a weapon used against you into your edge. Before we talk about traps, we need to build the foundation. We need to understand what the market is actually made of. The market is not a chart. The market is a collection of orders. Buy orders, sell orders, stop orders, limit orders, all sitting at different price levels waiting to be filled. This pool of waiting orders is called liquidity. Now, here's what textbooks don't tell you. Big institutional players, banks, hedge funds, prop desks cannot fill massive positions the way retail traders can. If Goldman Sachs wants to buy 500,000 shares of the S&P 500 futures, they cannot just hit market order and call it a day. That order alone would spike the price against them. They need a counterparty. They need a pool of sell orders large enough to absorb their buy. Where do those large pools of sell orders cluster? Right where retail traders place their stops. Think about it. Where does every retail trader put their stop loss? Below a swing low, above a swing high, on the other side of a key moving average. These are textbook locations. And because everyone is taught the same rules, stops cluster at the same price levels. This creates what smart money traders call liquidity pools. A swing high with stop losses sitting just above it is called Buyside liquidity. There are buy orders from shorts being stopped out or breakout buyers sitting up there. A swing low with stop losses just below it is Sellside liquidity. Sell orders from longs being stopped out. These are the hunting grounds. This is where price goes first before making its real move. Now we get to the deceptive part. Inducement. Inducement is the deliberate creation of a signal that appears to be a valid trade setup, specifically designed to attract retail order flow into a position that benefits the institutional player on the other side. Let me be direct. The market doesn't think. Institutions do, and those institutions understand retail behavior better than most retail traders understand themselves. Here's the classic inducement sequence. Pay close attention. Step 1. Create the structure. Price trends upward, forming a series of higher highs and higher lows. This is textbook bullish market structure. Retail traders watching this identify it correctly and begin looking for buy entries. Step 2. Form the obvious level. Price pulls back and creates a clear swing low. This becomes the key support level. Retail traders mark it. They place their stops just below it. This is the liquidity pool forming in real time. Step 3. The inducement candle. Price moves toward that swing low, maybe even slightly breaks below it with one aggressive bearish candle. What does this trigger? Two things simultaneously. Retail long traders get stopped out, stop loss sell orders execute, and breakout short traders see a breakdown and enter short. Both groups just created a massive pool of sell orders at exactly that level. Step 4, the reversal. With the stop hunt complete, the institutional buy orders that were waiting absorb all of that newly created sell liquidity. Price reverses sharply. The shorts get squeezed. The traders who got stopped out watch in disbelief as price goes exactly where they originally thought it would. That sequence is inducement. It is a fakeout engineered at a structural level to gather liquidity before the real move. This happens in every time frame, from the 1-minute chart to the weekly chart. The mechanics don't change.
There are several recurring patterns through which inducement and liquidity traps express themselves. Let's go through the most important ones. Trap number 1, the false breakout. Stop hunt. This is the simplest form. Price consolidates in a range, builds obvious support and resistance. Then it breaks convincingly above resistance, triggers breakout buyers and flushes shorts, only to reverse back inside the range and ultimately break the opposite direction. The real move was always lower. The breakout above resistance was pure inducement. grabbing buy-side liquidity before the institutional sell order could be filled.
Trap number 2, equal highs, equal lows. When price forms 2 or more highs at nearly the same level, every retail trader sees a double top and places their stop just above those highs. In smart money concepts terminology, those equal highs are a magnet. Price will frequently run directly into that level, triggering all the stops sitting above before reversing hard. This is a liquidity raid. The same applies to equal lows. Trap number 3, the breaker block. This is more sophisticated. Price breaks a key structure level, leaves behind an order block, a consolidation zone where institutional orders were partially placed, then returns to that zone. Retail traders identify the original structure break as confirmation of a trend and pile in as price returns. But instead of continuing, price reverses aggressively from the breaker block, trapping all the late entries. The institution used the pullback to offload positions into that retail demand.
Trap number 4. News-driven liquidity hunts. This one is particularly brutal. High-impact news releases, FOMC decisions, CPI prints, NFP reports create enormous volatility. What many retail traders don't realize is that price will frequently spike hard in one direction immediately after the release, only to reverse completely within minutes. The initial spike isn't the real reaction. It's a liquidity hunt, running stops on both sides before the institutional positioning takes hold and drives the actual directional move. If you've ever been stopped out on a news event only to watch price go your original direction, you've experienced this trap directly.
Now let's put this into the context of broader market structure. Because inducement doesn't happen in isolation. It happens within a structured framework of higher timeframe intent. The core concept here is multi-timeframe confluence. Institutional players operate primarily on the daily, weekly, and monthly timeframes. The moves on the 5 and 15-minute charts are executions of higher timeframe decisions. Here's how to think about it. On the weekly chart, price may be in a clear uptrend, targeting a specific premium supply zone. To get there, price needs fuel. It needs buy orders. How does it generate those buy orders?
By sweeping sell-side liquidity on the daily and 4-hour charts. Those daily sweeps look like breakdowns to the retail trader watching that time frame, but zoomed out, they're simply the mechanism for building the position that drives price to the weekly target. This is why retail traders constantly feel like they're being hunted, because on their time frame, they are. The higher time frame narrative is the only one that matters for directional bias. The framework I use, weekly/daily, define the overall narrative, direction, and major liquidity targets. 4H/1H, identify where price is in the draw, approaching buy-side or sell-side liquidity. 15M/5M, look for the inducement sequence and entry confirmation within the higher time frame narrative. Never take a lower time frame entry that contradicts higher time frame direction. That's one of the fastest ways to get trapped.
Now the part everyone's been waiting for. How do you actually use this? Rule number 1, stop hunting the obvious levels. If a support or resistance level is obvious, if you drew it immediately without thinking, so did everyone else. That level is a candidate for a liquidity hunt, not a safe entry zone. Learn to be suspicious of clean textbook levels. Rule number 2, wait for the liquidity grab confirmation. Don't enter at the swing low or swing high. Wait for the raid to complete. You're looking for a sharp wick below the level, followed by a close back above it on significant volume. That's the signature of a stop hunt completing. The entry is after confirmation, not before.
Rule number 3, use the inducement candle as your reference point. Once a liquidity grab occurs and you see a reversal forming, the inducement candle itself becomes your reference point. Your stop goes just beyond the extreme of that wick, because if price goes back below that wick, the setup is invalid. Rule number 4, align with the higher time frame draw. Before entering any trade, ask yourself, where is the higher time frame target? If you're buying a sell-side liquidity grab, is there clear buy-side liquidity above that price can draw toward on the higher time frame? You need the destination. Entries without destinations are gambling. Rule number 5, respect the news schedule. In the 30 minutes before major data releases, be flat
Or be aware, the pre-news liquidity hunts are well documented. Many traders find the best approach is to let the initial news spike resolve, both directions, before looking for a structured entry with the confirmed direction.
I want to take 90 seconds here to address something nobody talks about, the psychological component. Inducement works not just because of where stops cluster, but because of how retail traders feel at those moments. When price breaks below your swing low, you feel fear. You honor your stop. You exit. You've been trained to do that. And in that moment, your disciplined behavior is exactly the fuel the trap needs. The antidote is not to remove your stops. It's to restructure where your trade becomes invalid. Most retail traders place stops where their trade looks bad. Smart traders place stops where their trade's entire premise has been broken.
There's a massive difference. The first type of stop gets picked off by normal volatility. The second type only triggers if the market genuinely invalidates your thesis. This mindset shift alone, from reactive stop placement to structural stop placement, will cut your false exits by a significant margin. To bring this all together, the market is not random. The volatility you experience around key levels is engineered. Not by some conspiracy, but by the mechanical reality that large players need retail liquidity to execute their positions. Understanding this is not paranoia. It's market literacy.
Inducement and liquidity traps are the entry point into smart money concepts and ICT methodology, two of the fastest growing frameworks in retail trading education today. And for good reason. They describe market behavior at a structural level that technical indicators simply cannot. If this video added clarity to your market understanding, hit the like button. It genuinely helps this content reach more traders who need it. Subscribe if you haven't already, because next week we're going deep on order blocks and fair value gaps, the two structural tools that give you precise, high-probability entry zones once you've identified the liquidity sweep. Drop your questions in the comments. I read all of them. Trade with structure. See you next week.